Hi, and welcome to the Stockscores Market Minutes for April 6, 2015. This week I want to talk a little bit about fear and how we can overcome some of the common trading fears. The first fear that I want to focus on is the fear of losing money. That's what most people have. They don't like the feeling of losing money, but they have to realize that losing money is part of trading. If you are unwilling to lose, you end up taking bigger losses. One of the key things to do when you go into a trade is not take a position that is so large that the risk becomes intolerable. And so the key to overcoming the fear of losing money is just to have an acceptable risk tolerance on every trade you take. If you can't sleep well at night, then you're just simply taking too much risk. The second, I would say, the more damaging fear is the fear of missing out. We always worry that the stock that we are considering might be that big winner, and so it causes us to take marginal trades that end up not actually doing very well. Trades that maybe don't really live up to our standards, but we take them for that fear of missing out. What you have to realize is that there is a constant flow of trading opportunities in the market. If you pass on a trade and it works out to be a great trade, well, the reality is there's going to be another one that comes along soon. And so the best thing to do is make a list of your requirements, and if the trading opportunity does not fit all of those requirements, simply let it go. Finally, the fear that I want to talk about that I hear so often these days is the fear of a big market correction. Because of what's happened in 2000 and again in 2008 with these big market corrections that really crushed people's portfolios, and even more recently in the commodity space, the correction in the energy sector and in the gold mining sector, well, those big corrections are something that we remember very well, and we have a fear of them repeating themselves because they cause us so much pain. What you need to do is have a plan for how to profit from the correction. I love corrections because they create a great deal of opportunity. You can trade on the volatility as the market is moving down, and you can also take advantage of opportunity when the market reverses from its correction. So simply have a have a plan for how you are going to profit from the correction. When the long-term upward trend line is broken, you're going to get out of your positions and start to trade the volatility. When the market gets heavily oversold and is in panic mode, you're going to start to look for opportunities because that is the time to be a buyer. All right, let's get into this week's market analysis. This is the short-term chart of the S&P 500, something that is a bit worrisome because you can see here the falling tops over the last week or so. And the market's been a bit of a grind to trade in that time period because the sellers are basically showing some motivation and really the buyers are lacking motivation. Now this green line of support here is an important one because if we break down through that, we're probably going to get a more substantial move to the downside. What we've really had so far in the last 30 days is a market that's more or less going sideways. Not a lot of excitement, not a lot of strong price trend. But the falling tops on this chart are the worry because that is a sign that pessimism is building. If we can break the red line, then the pessimism is over. If we can break down through the green line, we're going to get more of a correction. So this is a real important chart to watch. It's the 30-day, 30-minute chart. I think what's going to happen is the market is looking for a catalyst of what to do next. And with earnings beginning in about a week, that is probably going to be the catalyst. The other potential catalyst is whether the U.S. Federal Reserve does something on interest rates or starts to telegraph what they are going to do on interest rates. So those are the things to watch for. Now, big picture, S&P 500 is still in a strong long-term upward trend. The bullish upward trend line has not been broken. What I want to highlight, however, is that the pace of the bottoms rising is steeper than the pace of the tops that are rising. And that again shows that the buyers are tentative and not willing to act aggressively. And really what's happening right now is the market's looking for an answer on what the Fed is going to do on interest rates. And second, are earnings going to be bad because of the strong US dollar or because of an economic slowdown? So the next few weeks as those earnings start to roll out, that's going to be real important in determining where the market goes. Now, I do see, as I've said many times in the past few weeks, that money is rotating out of the large caps with that expectation of higher interest rates going forward. Money is rotating out of those large caps and starting to look for opportunity in the small caps. And I think that's where the opportunity lies. So if you want to be more of a trader, we're actually getting into a very strong position type situation for traders because the small caps are starting to beat the large caps, and it's much easier to trade the small cap stocks. So I'm quite optimistic given this chart. I think it's still very early stage of this turnaround, but it is starting to look like a better market for traders. Now the TSX 60 kind of looks the opposite of the S&P 500 in the very short term, in that we've actually been starting to build some rising bottoms on this chart. We are still at that support, much like the S&P 500, but what's happening now is we're starting to see a little bit of strength coming back to the gold and energy sectors. Hardly anything to get excited about yet, but that is benefiting the TSX somewhat. So this is, again, very short-term outlook, but the TSX market does look a little better in the short term than the S&P 500. Now there's the longer-term chart of the TSX, and you can see that it is in a neutral sideways trading pattern going right back to the fall of 2014. I've got a green line on there of support and a red line on there of resistance, and whichever line gets broken is going to telegraph the next move. So we're getting into the narrow part of that triangle. If we can break up and through the red line, well then it's probably because the US dollar is weakening and commodity prices are accelerating. However, the more likely, I wouldn't say more likely, but the other alternative is that we break down through the green line, which is our line of support, which would indicate that there is continued weakness in the commodity sector, which of course has a heavy weighting in Canada. The TSX Venture has been stable for 3 months. It's a patient that's basically in critical but stable condition. Long-term trend is down and negative, but it at least has stopped going down. What we need now is a break up through that red line of resistance to indicate that investors are getting somewhat optimistic about the small cap Canadian stocks. 65% of this index is commodities, 35% not, and the not is what's holding up this market because the commodity area is still pretty weak. Now here's the chart of the Treasury Bonds. You can see that it bounced off of that long-term upward trend line. I think we're going to see it make a falling top. It's starting to do that already. A falling top, which is what we're building right now, is a sign of the pessimism coming in. So we've got this high back here. If this is a falling top from this high, we could go back down to retest that green upward trend line. And again, that would be telegraphing the market's expectation that the US Federal Reserve is going to start to raise interest rates. And that would cause bond prices to go down and yields to go up. US dollar made a falling top, and I thought this was a bit of a surprise because there is so many people believing that the US dollar is going to continue to move higher, and perhaps that's the problem. It's a crowded trade. With this falling top here, if we break the upward trend line, we could actually get a fairly sharp pullback in the US dollar because so many people are long the US dollar, so many people are short the euro. And with that many people on that trade, if it goes against them, they're all going to exit en masse. And despite the fundamentals of the US dollar, you could see the US dollar correct very sharply just because everybody is having to get out because they were on the wrong side of the trade. So still, no reason to sell the US dollar yet, but there is reason to be cautious because we are testing that upward trend line from a falling top. So I think you want to watch this chart closely. And that's perhaps given a little bit of stability to gold. You can see the last 3 weeks that gold has been able to close above its open those 3 weeks. Still in a negative pattern, but if that US dollar does come back and we break down or break up through that red line of resistance, we could see a little bit of a snapback rally in gold. I am not by any means suggesting you go out and buy gold yet. I'm saying it's something to watch for. It's the unexpected thing that actually is starting to show some signs that it could happen. Don't get too optimistic about it yet, but certainly watch the chart for a break of that red line. Same on oil. Similar chart, the US dollar starting to show some weakness. Perhaps that will give some support to oil, which is threatening that downward sloping red line of resistance. You can see that the tops are falling faster than the bottoms are falling, and that is a sign that the sellers are getting tired. Again, I don't want to get anyone too optimistic until that red line is broken with some real strong price action up through $11 on this ETF, for example. You don't want to get too optimistic, but it is something to watch for because nobody's really calling for that or expecting that, and yet the chart is starting to tell us that there may be something cooking there. Fear is really at a considerable low right now. I would say complacent. The pattern on this chart is a falling wedge, which is actually a potentially bullish pattern if that red line is broken. So we've got a lot of potential reversals shaping up. There is not yet a sign of those reversals, but I am watching them very closely, and certainly I will report on them for you in the weekly market minutes video. So bullish long term still on US stocks, a little bit bearish in the short term. Canadian stocks neutral on both time frames. Gold and oil still bearish on both time frames, but we do have some, hint that we could see a break of those negative outlooks. The buyers continue to lack motivation in equities, but the sellers are also not that strong. This is a complacent market looking for a catalyst to tell it what to do next. Earnings season may be that catalyst. Commodities are stabilizing, but still not overcoming their pessimism. So remain cautious on gold and oil, but watch for a break of those red lines of resistance that I had on the chart. Well, that has been the Stockscores Market Minutes for April 6, 2015. Have a great week in the market and trade well.